On March 15, 2023, at 9:35 a.m. Eastern Standard Time, the bustling financial district of Manhattan became the epicenter of an unforeseen crisis when an algorithmic trading system, known as TradeSmart, belonging to the global investment firm Quantum Capital, malfunctioned. Quantum Capital, a respected player in the financial markets with over $100 billion in assets under management, relied heavily on automated trading strategies facilitated by TradeSmart. This system was designed to optimize trades across multiple stock exchanges by leveraging real-time data and executing decisions at lightning speed. The unexpected failure began with a misconfiguration in the algorithm's risk assessment parameters. The TradeSmart system utilized complex mathematical models to evaluate market conditions. However, a recent software update inadvertently altered the thresholds that governed these models, creating an oversight in the system's ability to distinguish between normal market fluctuations and genuine trading signals. This misconfiguration opened a pathway for erroneous trades to be executed without sufficient checks, as it failed to account for spike events in volatility. Less than 5 minutes after the initial misconfiguration, TradeSmart started executing trades at an alarming rate. In a matter of seconds, the system initiated thousands of automated transactions, purchasing over 1.5 million shares of various stocks across different exchanges, far exceeding normal trading volumes. This surge translated to an estimated $450 million worth of undesired buys, resulting in an immediate increase in transaction costs and putting downward pressure on stock prices. As TradeSmart's abnormal behavior continued, the first measurable impact became evident. By 9:50 a.m., several prominent stocks saw their prices altered significantly due to the excess trades. Shockingly, shares of companies in sectors ranging from technology to consumer goods experienced an average price increase of 5% within a short time period, attributed entirely to the ill-timed buying spree. The volume of trades began to disrupt the standard market flow, escalating tensions and exhibiting a clear anomaly during what was supposed to be a regular trading session. Within Quantum Capital, the immediate reaction to the malfunction was marked by confusion. Internal emails bombarded traders as they rushed to analyze the situation, attempting to determine the cause of the erratic trading behavior. The firm's incident response team convened rapidly, using their designated incident channel to sort through the growing chaos of preliminary data alerts. Initial assumptions pointed toward possible external market manipulation before the team realized it was an internal issue. Meanwhile, partial fixes were attempted, with some traders trying to manually halt trades, while others modified algorithm parameters in real time, each leading to further confusion. External signals began to crop up almost immediately. Trading partners noticed unusual spikes in trading activity, and alerts started pouring in from analytics platforms reporting abnormal price movements. By 10 a.m., retail investors took to social media platforms to voice their concern, with posts documenting the confusion surrounding the rising stock prices. Financial news outlets published minor mentions of significant trade disruptions, igniting interest but not yet recognizing the gravity of the situation unfolding. As the minutes slipped by, the situation deteriorated further. TradeSmart continued to engage in undesired trades, despite the efforts to impose corrective measures. Transaction logs indicated the system did not effectively record half of the erroneous trades, due to a lack of adequate logging mechanisms. This failure highlighted a substantial process gap within Quantum Capital's oversight of their algorithmic tools. Access control settings had not been reviewed in conjunction with the latest software updates, further exacerbating the issue. By 10:30 a.m., the first significant signs of market panic emerged as investors scrambled to assess the unfolding crisis. Prices began to drift downwards, influenced by fears of potential instability. Even as quantum capital struggled to retain control of TradeSmart, external market forces began to intercede. Other financial institutions, realizing the magnitude of the situation, proliferated similar panic selling among their own automated systems as they scrambled to adjust strategies in reaction to the perceived market swings. As the trading day continued, the consequences of the algorithmic oversight spiraled deeper into the fabric of the financial markets. Regulatory bodies, accustomed to monitoring potential market manipulations, found themselves ill-prepared for the tsunami of trades initiated by an internal failure at a major financial institution. Investigations were being launched into quantum capital's internal practices, and other firms began to brace themselves for the ripple effects that were now undeniably shaping the trading environment. With the clock moving past noon and the issue still unresolved, employees within Quantum Capital prepared for what was shaping up to be a long day ahead. The repercussions of TradeSmart's malfunction loomed large, and the realization that a minor technical oversight had led to a major financial disruption lingered in the air. As market reactions grew more severe, they began to recognize the systemic vulnerabilities in algorithm management, hinting at the chaos that lay beyond their corporate walls. By 1 p.m., a full-blown crisis had unfolded. The Dow Jones Industrial Average had already dropped by over 800 points, with market participants declaring a state of emergency. The situation prompted interbank communication regarding the risks posed by the erratic transactions stemming from Quantum Capital's faulty algorithm. Initial estimates indicated that over 20% of trades executed during the chaos were erroneous, leading to an approximate financial loss of $5 billion across multiple trading platforms. As TradingSmart continued its malfunction, the financial consequences became more pronounced. By mid-afternoon, numerous hedge funds and retail investors reported severe losses. The combination of forced sell-offs, cascading liquidations, and algorithmic trading failures began to engulf the entire market, resulting in massive liquidity withdrawals which further exacerbated market volatility. Third-party dependencies, including payment processors and trading platforms, faced significant delays, with outages reported across multiple networks as systems struggled to cope with the bottleneck of erroneous transactions. Faced with an earnings disaster, Quantum Capital activated their incident response plan. They contacted law enforcement and regulatory agencies, including the Securities and Exchange Commission, SEC, to formalize a report of the ongoing issue. By 3 p.m., the SEC issued preliminary notices to Quantum Capital regarding extraordinary trading data, requiring immediate disclosures of their algorithm's performance and the actions taken during the crisis. Concurrently, internal audits were initiated to trace the root causes of the failures and assess damages incurred. As communication lines opened between affected institutions, information began to circulate within the industry regarding TradeSmart's algorithmic malfunction. By the afternoon, insights gathered from internal chat logs within Quantum Capital and discussions among trading firms found their way to major financial news outlets. Data visualizations demonstrating the rapid trade volume surges quickly became front-page news, signaling a full acknowledgement of Quantum Capital's role in the market disruption. In the weeks that followed, the consequences of the malfunction only grew. By the end of the trading week, key players within the financial landscape were seen scrambling to reevaluate their reliance on algorithmic trading systems. The SEC formally announced a comprehensive review of algorithmic trading regulations and called for an industry-wide audit of risk management practices. Emergency sessions were held to address gaps in oversight and improve transparency in algorithm management. By the end of the month, quantum capital found itself at a watershed moment. Legal pressures mounted as investors began to file class action lawsuits against the firm, claiming negligence and loss of earnings due to their inability to manage the algorithms effectively. Concurrently, the firm's management faced scrutiny from regulatory bodies, with subcommittees convening in response to the widespread financial impact triggered by TradingSmart's dysfunctional operations. On December 15, 2023, Quantum Capital was served with subpoenas from various federal agencies, requiring testimony from executives about the operational failures surrounding TradeSmart. Public speculation mounted regarding the potential legal ramifications and corporate restructuring in the wake of the incident. As the financial landscape adjusted to the newly exposed vulnerabilities, Quantum Capital announced a significant strategic overhaul. On January 15, 2024, they declared a comprehensive ban on the use of certain high-frequency trading algorithms and implemented rigorous internal controls over their trading systems, followed by an extensive retraining program for their employees. Notably, several top executives offered their resignations as an acknowledgement of accountability for the catastrophic oversight. The financial fallout prompted even larger discussions across the industry regarding systemic risks inherent to algorithmic trading. Regulatory authorities began drafting policies intended to establish better oversight of automated trading systems, enhancing real-time monitoring mechanisms, and requiring the implementation of fail-safes in trade execution protocols. However, the ramifications stretched beyond policies and resignations, as major institutional players cautioned their clients and stakeholders about the volatility of relying solely on automation. With skepticism permeating the market, numerous funds recalibrated their strategic approaches, resulting in tighter capital requirements and a renewed focus on traditional trading methods. By February 2024, the market had shown signs of recovery, although the incident heavily tarnished the reputation of Quantum Capital. Investor trust had eroded, leading to significant capital withdrawals from their funds. Legal battles ensued for months, culminating in settlements that further drained the company's finances. Ultimately, by April 2024, Quantum Capital declared bankruptcy following extensive legal fees and operational losses. The company's assets were liquidated, and it ceased all trading activities by May 2024. The entire saga revealed the critical importance of oversight in algorithmic trading systems. It prompted fundamental changes in the landscape of financial trading, reinforcing vigilance against algorithmic mediocrity. As of April 2024, Quantum Capital remains defunct, its systems dismantled, and its role in the incident serving as a potent reminder of the risks posed by unchecked automated financial processes.